Welcome back. It's been a rough run under the surface for consumer stocks, with a number of discretionary groups falling by double digits over the past 3 months. And our next guest is flagging a new warning sign in the charts. Joining us now is Jonathan Krinsky, Chief Market Technician at BTIG. Jonathan, good to have you. Thanks for joining. And what specifically concerns you within consumer discretionary in terms of the subsector action?
Well, hey, good to be here, Mike. It's really a lot of things. We can look at the home builders, which are below their 200-day for the first time since November today. But really, we're flagging the restaurant group. If we look at the Russell 3000 Restaurant Index, which is really the broadest measure of restaurants, that peaked in late February. Has down about 10% since then, breaking below its spring lows, which is one of the few kind of industries that has broken below those April lows. So there's definitely something going on here. Clearly doesn't point a great picture for the consumer, given restaurant spending is pretty discretionary, and it's really that now there are some idiosyncratic stories still holding up well. You can look at Kava. Or Wingstop, but even some of the darlings like Chipotle have started to break lower now. So it's pretty broad-based weakness across the group, and probably not a great sign for the consumer given what's going on there.
Yeah, I was going to ask in terms of in the past, if there's a way of describing a pattern that tends to hold. Is this somewhat of a bellwether group for the broader market? Does it just mean move away from other consumer cyclicals?
Yeah, I don't think there's a clear-cut, pattern for restaurants per se. Actually look back, they kind of topped coincidentally with the market back at the 2007 highs, just for one example. And to be clear, the relative weakness here in the group has been persistent for about a year now. They started underperforming last summer. So it's not so much the relative weakness. We see relative weakness across many parts of the market, including industrials, healthcare. You can go down the list, but it's really the renewed absolute breakdown. We're seeing a lot of 52-week lows in the group. And again, it's high end and low end. It's Cracker Barrel on the low end. It's Starbucks has persistent weakness. It's McDonald's. So, it's really widespread. And I think that's kind of the more concerning tone. And then you combine that with the fact, again, we mentioned home builders breaking below the 200-day. They've been weak the last few months. Different cyclical parts of the market, including industrials. So it's outside of tech. It's hard to find things that are working very well right now.
Yeah, I mean, I guess all those things you just ticked off probably are okay from a disinflationary signal standpoint, but maybe not for in terms of the momentum of the economy. You've thought for a while that this whole split market with the narrow mega cap leadership, there was more likely that the large stocks and the big cap indexes might retreat to meet the average kind of laggard stock in the market. Obviously, ball stayed in the air for a while here. We seem like it's one or two mega caps a day. Seems like it manages to support the index. And now today you have a decent sized break. Do you still feel like that's what we're in for here?
It's really tough. It's, at the same time that we continue to expect mega cap to falter, you'd think by now 6 months or 7 months into the year, you'd get some breadth expansion, and neither has happened. It's only gotten, the spread has only exacerbated wider. We've had the biggest first half spread between the S&P and the equal weight since 1990. We actually looked at something else interesting today. We looked at, it's been 43 trading days since the last time all of the Mag 7 names were down on the same day. We've only had one streak longer since 2015. That was 44 days back in June of 2016. So, we continue to see this kind of whack-a-mole market where maybe NVIDIA takes a breather and then Apple steps up. Google pulls back, Amazon steps up, right? So until that mentality of, money just sloshing around between those Mag 7 names, until that ends, it's difficult to get that broad pullback. And the trigger for that is always a difficult timing tool. But again, we have volatility on year-to-date lows here. It's been 18 months since the NASDAQ 100's had a down 2.5% day. That's the longest streak ever. So we're really in rarefied air up here. Again, calling the end to it is difficult, but I do still think at this point it's more likely that those big cap names kind of pull back, even if it's just temporary, short term. Again, given you've had 6 months for the opposite to play out, and it hasn't played out yet.
Right. Yeah. No, it's been confounding, and it seems almost a little bit improbable that it's gone on this long. Although I'm sure people would come back to you and say, you're describing, a bull market. People want to maintain exposure. They don't want to sell everything across the board. They find something to own when one thing goes down, and maybe that's that's healthy if a majority of the market, meantime, is kind of not extended and is sort of resting.
Yeah, I mean, it's certainly a bull market within, mega cap, those top names, but it's anything but a bull market if you were to, look historically at what the equal weight S&P is doing, or small caps in particular. So look, I mean, we're still open to that scenario. It wouldn't take much for small caps to kind of break out of this range and get some momentum going. It just hasn't happened, and I think it's frustrated many that we just can't seem to get that convergence.
Yeah, it's happened in these short little bursts, right? Nothing too sustained. Jonathan, appreciate the time. Thank you.